Welcome to Seeking Alpha's Wall Street Lunch, our afternoon update on today's market action, news, and analysis. Good afternoon. Today is Wednesday, November 15th, and I'm your host, Kim Kahn. Top story so far. It's the busy time of year for money managers. The third quarter 13F filings are rolling in. 13Fs disclose equity holdings of institutional investment managers who have $100 million or more under management. Here's a snapshot of the moves made by some of the big names that Seeking Alpha subscribers follow closely. Michael Burry of The Big Short fame closed out his $1.6 billion broader market short that he opened in August. Burry's Scion Asset Management reported that it no longer held 2 million puts on the Spider S&P, or SPY, and 2 million puts on the Invesco QQQ Trust. Scion also disclosed a new short on chip stocks, with 100,000 put options for the iShares Semiconductor ETF, or SOX. Warren Buffett's Berkshire Hathaway exited its stakes in General Motors and arbitrage play Activision Blizzard. It also divested smaller stakes in J&J, Mondelez, Procter & Gamble, and United Parcel Service. Bridgewater Associates, the hedge fund founded by Ray Dalio, boosted its holdings in 3M, Abbott Labs, and Best Buy. It exited its positions in Apple and Shopify. Duquesne Family Office, run by Stan Druckenmiller, shifted some investments in technology, closing out its position in Meta Platforms, but taking a new stake in Google parent Alphabet. David Tepper's Appaloosa exited its holdings in Apple, Marvell Technology, and Broadcom. It boosted its stakes in Meta and Microsoft. Bill Ackman's Pershing Square Capital increased its stake in Alphabet while trimming its position in home improvement retailer Lowe's. And Carl Icahn boosted his stakes in Southwest Gas and his own company, Icahn Enterprises, while he exited his position in Xerox. You can see more 13F disclosures and screen using quant and analysis to see if any of the stocks fund managers now like are a fit for your portfolio. Head on over to seekingalpha.com/subscriptions. In today's trading, more tame inflation data arrived before the bell, this time on the wholesale side. The Producer Price Index fell 0.5% in October, the biggest drop since April 2020, due mainly to a slump in gas prices. The core PPI, which excludes food and energy, came in flat. Both were softer than economists were expecting. Julia Pollock, chief economist at ZipRecruiter, said, "For all those who say that we're only seeing slowing inflation but that prices aren't actually falling, may I present the Producer Price Index. The prices companies charge for goods fell 1.4% in October." But she added that consumers notice cumulative inflation over longer periods rather than monthly moves. On the top of Tuesday's cool CPI, the PPI brought out clarion calls from equity bulls. Joe Kunkel, founder and CEO of Options Hawk, says, "We follow up a super soft U.S. CPI print with Eurozone inflation collapsing, China recovery taking hold, and then this morning, U.S. stronger retail sales, Empire Manufacturing, and soft PPI. Bears must be pulling their last hairs out." Wedbush tech analyst Dan Ives says, "Let this new tech bull market rip higher into 2024. Big tech, software, chips will lead us higher into 24. The AI revolution has begun. Bears head back into hibernation." But investors look reluctant to buy hand over fist today after the rally in the previous session came in so strong. The major averages are up about 0.5% amid a rebound in yields. Small caps continue to rip, though. After a 5% rally in the previous session, the Russell 2000 is up another 1.5%. The bond market looks less impressed with the PPI and more concerned with stronger than expected October retail sales. The 10-year Treasury yield is back close to 4.55%, making up a good deal of Tuesday's tumble. Headline retail sales dipped 0.1%, while core sales rose 0.1%. Both top forecasts, and the strong September was revised even higher. Wells Fargo says they expect current conditions to allow for a decent holiday sales season for retailers, but we are likely to see the slowest pace of annual sales growth since ahead of the pandemic, and they remain cautious on the prospects for spending in the new year. Among active stocks, Target soared after the retailer flew past Q3 consensus estimates. Target reported comparable sales decreased 4.9% during the quarter versus the 5.2% consensus. Declines in discretionary categories were partially offset by continued growth in frequency categories, most notably in beauty. Zim Integrated Shipping slumped after it incurred a large net loss of $2.3 billion for the quarter, compared to net income of $1.17 billion in the year-ago period. Its bottom line was weighed down by a non-cash impairment loss of $2.06 billion. Revenue tumbled 61% year over year to $1.27 billion. And EV maker XPeng says the journey to long-term profitability has started. The company's vehicle margin improved sequentially to down 6.1% from negative 8.6%, and gross margin was negative 2.7% versus negative 3.9% in Q2. In the Wall Street Research Corner, money managers are getting more invested, pushing big bets into bonds and coming around to equities, according to the latest B of A survey. The November Fund Managers Survey showed a big drop in cash levels, down to a 2-year low of 4.7% from 5.3% in October. Lots of that cash went to bonds, where managers are now the most overweight since early 2009. Strategist Michael Hartnett says, the big change in the November Fund Managers Survey was not the macro outlook, but rather the conviction in lower inflation, rates, and yields. That's evidenced by the third largest overweight in bonds in the last 2 decades. Only in March 09 and December 08 were investors more overweight bonds. Stocks also got some love. A stable macro outlook and much more optimistic view on rates has taken Fund Manager Survey investors' equity allocation overweight for the first time since April 22. That's all for today's Wall Street Lunch. Look for links to the stories mentioned in the show notes section. Don't forget, these episodes will be up with transcriptions at seekingalpha.com/WSB. And if you're not a subscriber, you can get full access at seekingalpha.com/subscriptions. A quick reminder that none of this podcast constitutes investment advice. Thanks for listening.